Hi, I wanted to talk about asset allocation strategy. This is really important because no matter where you are in your life, and obviously if you're investing, then you need to really be considering what types of assets you want to invest in and what the allocations should be across the different assets. And most of the time, what most people invest in, it's going to be fixed income assets, which are bonds, and then equity. So stock equity. So those are the two predominant ones that most people invest in. And that's okay. That's great. I mean, because there's a little bit of a counterbalance between the two of them. Not all the time. But if you do want to also bring some other diversity into your portfolio, then yes, you can also have some gold. You can actually have some other commodities. You can have real estate. You can also bring in private equity or private investments into it. Although there isn't much of a difference in reality. I mean, between the private and the public in general, um, obviously with the private, there is less liquidity around it, unlike the public investments or equity investments. But anyway, we can touch on all that. But I did want to go through some of the key factors when it comes to deciding. And I'll also run through an example between 1990 and 2015. I probably won't do it in this session, but I'll do it in a follow-up session just to give you a nice time frame of how you can actually do and invest in based on what the asset allocation or what the asset returns were actually for that time period. It's a 25-year time period, which actually includes a couple of recessions, pretty severe recessions actually. But we also had some growth in there. So I will show you that not in this session, but in the next session. Um, I mean, the objective of asset allocation, it's to really maximize your returns on a risk-adjusted basis over time. So you want to get, you know, a maximum return, but under less risks as much as possible. So you want that adjustment or that basically that ratio to be high, where again the return is high, but the actual risk associated with that return is also very low, and that gives you a very, very high ratio. And that's what you're looking for as much as possible. In some cases, if you really want to, get to extreme returns, um, you may have to sacrifice some of that risk, some of that low volatility risk, and potentially, again, depending on your age and again where you are, you can focus a bit more on that risky side of the equity type returns. And one thing that you're always trying to do is balance between growth, I mean, growing your investments versus capital preservation. You don't want to lose what you have, and that's what that means. You want it to grow, and you want it to grow, on a sustainable basis, but you don't want to have major losses along the way. And sometimes, again, when you're young and you're basically all in, especially on the equity side, you may have to stomach some of those big losses along the way, especially whenever there is a recession or severe recession like we had back in 2008. But if you've got time on your side, again, you can kind of like sidestep that uh, the concern or more of the concerns around capital preservations. But as you get older, and especially when you're in retirement, that is a very, very, very important factor. And you don't want to sidestep that. You do want to keep your capital, your investments as preserved as much as possible. You don't want to lose them. You don't want it to go down especially when there's a time when you're actually going to need a lot of it or most of it. So you want to preserve that. So it's a balancing act. And the other thing is, like anything, when it comes to allocations, it's something that you adjust along your life stages. When you're young, you can be very aggressive. As you get older, and you have a family or you have kids and you have other things that are dependent on you, then maybe you can't be as aggressive and you have to be a little bit more conservative on some of the investments. And so it's always changing depending on where you are, not only from a time perspective, but also as to what's going on in your life at that point in time. Some of the key drivers, to allocation, type of allocations that you would do. Age is a big one, and which ultimately gets back to your time horizon. How much time do you had ahead of you? Do you have ahead of you to invest and let your investments grow and save and so forth? And so that is huge. That's probably the biggest one, I think. The next one that's probably right up there is the risk tolerance. And there are two sides to that. There is the behavioral plus the financial. And what I mean by behavioral is that some people they just enjoy taking risk. That's part of their personality. Um, and so they can sometimes, or they will want to be more aggressive, especially on their investments. However, the financial side of things, if you've got lots of savings, lots of money already set aside, and you are also very aggressive, then you can take some risks because you've already gotten so much that if there is a little bit of a downside along the way or in your investments, it won't be as impactful because you have more than what you need essentially. If you don't have financially more than what you need, if things are tight and you have some upcoming events that are going to be very critical in your life, and you are very aggressive in as far as in general how you'd like to invest, you may have to really take a back step and say, "Hey, I need to be less aggressive," and you should be, and you have to be actually, because again, from a financially speaking standpoint, you don't have that kind of room to be as aggressive, and so again, it's also a balancing act between these two things, and you always have to be aware of where you are in your life and the surrounding events around you when it comes to your behavior as to how you want to invest and where you are financially. Income stability, if your investments, if you're really very dependent on your investments for income, that's a very critical factor. And it becomes very critical, especially later in life where you want to retire and you really are going to be very dependent on your investments to generate the income that you need. So income stability is really, really key. And again, so one of those factors that when you're young, you don't really need it as much, especially from your investments, but later in life you will. Market cycles and valuations. You know, it Nobody can time the market. Um, some people can actually time it roughly, when things start going down or when things start picking back up. But it's hard to really time it. And you can't. I mean, you shouldn't even try. But you need to know where things are when it comes to market cycles as well as valuations. Like right now, the market's it's gone up a lot. It's actually gone up a lot over the last few years. And so we are at a very high point on the market cycle. And from a valuation standpoint, things are actually a bit stretched, actually, in some cases. And again, it all depends from which perspective you're looking at. I mean, obviously, we have new technologies and we have things that are happening, especially around AI, that are going to be around with us for many years to come. And so there is going to be future increases in the valuation, especially on some of the companies, some of the stocks, obviously. But you just need to know where you are relative to, again, the cycle and also where you are from an economic cycle and where things are from a valuation. If things are stretched, the things have gone way too far ahead, especially over a few months or over years, and you need to really be very, very conscientious of that and really take that into account on the investments that you do make and the allocations that you actually focus on. The last thing I'm going to talk about, for this session is that the life cycle allocation framework. I mean, these are the things and these are very general, but early stage, when you're young, you want to maximize growth. I mean, you really want to focus on the assets that give you the maximum return as much as possible and maximum growth. Mid stage, again, when you're later in life, you have a family. When I said again, going back to the early stage, when you're like in your teens and your 20s and even 30s, you can be very aggressive. When you get to your mid stage, when you're 40s and 50s, again, you want to balance things up a little bit, especially and again, this is very generalized. Many things depend on where you are, what's going on in your life, but you want to be able to balance growth and preservation. You've already hopefully accumulated quite a bit of capital, of quite a bit of uh, investment capital, in your 40s and 50s. And so you don't want to lose it. You want to preserve some of that as much as you can, if not all of it. Obviously some of it's going to be put on risky investments. And so there is a chance but you don't want to have everything on risky investments. And in late stage, you focus on income stability. You really don't want to have any large shocks, um, come in and actually hurt your investments. You want stability. You don't want it to fluctuate too much. You don't want to have too much volatility around it. And especially when you're very dependent on the income from your investments. So you have to be very careful. And very, very smart and wise on the investments. And there are ways to take risk while also reducing um, the potential for losses that comes with some of that risk. And again, there are some advanced strategies for that, but we won't get too much into that. But again, I just wanted to put that in, and then like I said, we'll do another session where we'll actually do an example and talk about some of the more details around these different things, this framework, for actually how you should look at and do what you should do with your asset allocations.